You have money. You want that money to grow. But the moment you step into the world of investing, you are hit with an alphabet soup of acronyms. Mutual funds, ETFs, index funds, hedge funds. Most people think these are assets, like buying a house or gold. They aren't. They are vehicles. Think of them like different types of transportation to get you to the same destination: wealth. One is a luxury private jet that costs a fortune to board. One is a public bus, reliable but crowded. One is a sports car you drive yourself, and one is, well, autopilot. Today, we are going to break down exactly how these four differ in terms of cost, control, risk, and returns. By the end of this video, you won't just know the definitions, you'll know which vehicle you should be riding in. The old guard, mutual funds, active. Let's start with the grandfather of modern investing, the mutual fund. Specifically, the actively managed mutual fund. Imagine you and 1,000 other people put your money into a giant pot. You don't have time to research stocks, analyze balance sheets, or watch the news. So, you hire a guy named Dave. Dave is a professional fund manager. His job is to use that giant pot of money to buy and sell stocks for you. He is trying to beat the market. If the market goes up 10%, Dave wants to get you 12%. The catch: fees. But Dave is expensive. Dave needs a salary, a team of analysts, and a fancy office. This brings us to the expense ratio. Mutual funds often charge 1% to 2% of your money every year, regardless of whether they make a profit or not. Pros: professional management. You do nothing. Dave does the work. Diversification. You own a slice of hundreds of companies instantly. Cons: high fees. That 2% sounds small, but over 30 years, it can eat up 40% of your total gains. Human error. Statistically, 80 to 90% of active fund managers fail to beat the market over a 15-year period. Dave usually loses. The revolution: index funds, passive. Enter the index fund. If mutual funds are active, index funds are passive. Instead of hiring Dave to pick the best stocks, an index fund simply buys all the stocks. If you buy an S&P 500 index fund, you are buying a tiny piece of the top 500 companies in America. If you buy a Nifty 50 index fund, you buy the top 50 in India. The philosophy here is, don't look for the needle in the haystack, just buy the haystack. The math. Because there is no Dave, no expensive manager to pay, the fees plummet. Instead of 2%, you might pay 0.05% or 0.1%. Pros: ultra low cost. You keep more of your money. Market returns. You will never beat the market, but you will never lose to the market. You are the market. Peace of mind. No need to worry if a manager is making bad calls. Cons: boring. It's average. You won't get a 1,000% return overnight. It is a slow, steady wealth builder. The modern hybrid: ETFs, exchange-traded funds. Now things get interesting. ETFs, or exchange-traded funds. Structurally, an ETF is almost identical to an index fund. It usually tracks an index, like the S&P 500 or NASDAQ. But there is one major difference: how you buy it. Mutual/index funds. You can only buy or sell them once a day, after the market closes. The price is set at the end of the day. ETFs. They trade like stocks. You can buy an ETF at 10 a.m. and sell it at 10:05 a.m. The price changes second by second. Why does this matter? Liquidity and taxes. ETFs are incredibly tax efficient and flexible. The strategy: Broad market ETFs, like VOO or SPY, US, or Nifty Bs, India. These act just like index funds. Sector ETFs. You can buy an ETF that only holds tech companies, or only holds gold, or only holds oil companies. Verdict. If you are a long-term investor, index funds and ETFs are 99% similar. But if you want to trade during the day or buy specific sectors, ETFs are the superior technology. The VIP Club, hedge funds. And finally, the hedge fund. This is the one you see in movies like The Big Short or Billions. Hedge funds are not for regular people. They are unregulated or lightly regulated investment pools for the ultra-wealthy. To even enter, you usually need a minimum investment of $1 million or $5 million. The strategy. Unlike the other three, hedge funds don't just buy stocks hoping they go up. They hedge. They can bet against the market, short selling. They use massive leverage, borrowed money. They buy derivatives, art, private companies, or distressed debt. The cost, the 2 and 20 rule. Hedge funds are famously expensive. The standard fee structure is 2 and 20. 2% management fee, just for showing up. 20% performance fee. If they make a profit, they keep 20% of it. The reality. Are they worth it? For 99% of people, no. While some hedge fund managers become legends, like Ray Dalio or George Soros, the average hedge fund actually underperforms the S&P 500 index over the last decade, after you subtract those massive fees. Conclusion: which one is for you? So, let's summarize the verdict for your wallet. Mutual funds, active. Good if you believe a human can beat the market, but be careful of high fees. Generally, these are becoming outdated. Hedge funds, only for the ultra-rich who want unique, high-risk strategies, not for retail investors. Index funds, the king of passive investing. Perfect for your retirement account where you automate it and forget it. ETFs, the modern standard. Low fees, high flexibility. Great for both beginners and pros. If you are starting today, a low-cost ETF or index fund is statistically the smartest way to build wealth. Don't look for the needle, buy the haystack. Thanks for watching. If you want a deep dive on exactly which ETFs are best for 2026, let me know in the comments.